Hey, what's happening? What's happening? Hey, I'm back and I'm doing a series of videos, and this is the start of that, talking about Warren Buffett, the great legendary investor, considered by many to be the greatest, most intelligent investor of all time. Certainly the greatest, or at least one of the greatest living investors. So, Warren Buffett, who he is, a billionaire, one of the richest men in the world, in the history of the world, and a lot of wisdom for the ages. And so, a couple of books that have profoundly impacted me and my investing, my approach, and really my life. A couple of books. One of them is Warren Buffett's favorite book, and the book that he recommends on investing for any investor, and it's called The Intelligent Investor by Benjamin Graham. And Benjamin Graham was a kind of an idol and a mentor, literally a teacher, and one of the first partners of Warren Buffett that influenced Warren Buffett, a young Warren Buffett, several years ago. So The Intelligent Investor is one of those books, and I'll talk a little bit about that. And the other book is called The Snowball, and that's a biography by Alice Schroeder about Warren Buffett, his life, and practical applications from his life in investing. And so in this video, I'm going to talk about three famous Warren Buffett quotes. He has several hundreds, maybe even thousands of quotes and learnings that can be taken and we can make practical applications to become better investors. And I think better people and better stewards. And so in previous videos, I've talked about accumulating wealth, building wealth for the long term, investing, compound interest. I've talked about a lot of these concepts. A lot of them are based on Warren Buffett and a lot of the teachings and things that he professes and teaches and encourages others to do. And so the three quotes that I want to talk about today, the first quote is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And I'll talk about the practical applications of that in investing. The next quote is, famous Warren Buffett quote is, "You'll know who's skinny dipping or you'll know who's swimming naked." There's been two ways to paraphrase, or two ways that Warren Buffett's quoted. You'll know who's skinny dipping or who's been swimming naked when the tide goes out. And then the third quote is, "Be fearful when others are greedy and greedy when others are fearful," in terms of investing. And so the first quote, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And really what that means is, when investing, and Warren Buffett talks about, especially in The Intelligent Investor, and then there's stories about him in the Snowball by Alice Schroeder, the biography of him. What he talks about is, when you buy stocks, you're buying a company. And so you need to buy something that you understand, invest in a company that you understand. And it should be as simple as that. And so when you're buying stocks, you're buying a company. Buy a company that's a great company at a good price. Don't look for the bargain basement, the cheapest stock that might pay the highest dividend yield, that might not be a great company, might not have a great balance sheet, might be in debt, might not be making profits, might have a number of disadvantages, but it looks like it's a great price, or people have told you, Mr. Market, the concept that the crazy stock market and the crazy prognosticators may have said, or even someone that wasn't crazy said, you should buy this, it's at a good price. What you need to do is your homework. You need to study, and you need to know that it's a great company. And if you can find a great company at a fair price, that's the best way to invest, because most of investors lose a lot of money when they're buying something that's not a great company. It doesn't have underlying a great profit margin. It doesn't have a great balance sheet, might not have great managers. It might not be good in the long run, but it seems cheap. Seems like it might even pay a dividend. And so if you invest in that company, you're more likely to lose money, or certainly over the long term and possibly over the short term. So that's why Warren Buffett said, it's far better to buy a wonderful company at a fair price than a fair company and than a marginal company at what seems like a wonderful price. The second quote is, you'll know who's been swimming naked, or you'll know who's been skinny dipping when the tide goes out. And really the application there, and what Warren Buffett was getting at, his bigger point was, when you have to go into debt, and when you're taking all kinds of risks, it might seem great when the stock market's up, when the market's up, when a lot of people might not be paying attention. So in other words, when the water's high and you can't see what's underneath the water, you might be able to see the tip of the iceberg, so to speak, but not underneath it. At that point, it looks like people are doing great. Looks like people that are highly marginalized, that are in debt, might be making very bad investments. They're showy, and it seems like things are going great for them, and they're great investors, and they might even be flaunting it. But really, in reality, underneath the water, they're skinny dipping, they're naked, they're in debt, they're making bad investments. And you only know that, and you most often see that during the bad times, when the market goes down, when the margins are called, when they have to pay their debt back. Then that's when you see the bankruptcies. That's when you see those investors that have made those poor investments, and then it becomes exposed, right? And then you know that they were skinny dipping, or they were swimming naked when the tide goes out. And so the analogy of the ocean and the water. And if you read the books about Warren Buffett, his biography, and certainly an Intelligent Investor as well by Benjamin Graham, but in any biography, any story about Warren Buffett, he liked to vacation. He used to vacation, and lots of stories of California. So that quote analogy about the ocean is and the tide is a very interesting one. And so the next quote is the final quote of the three that I was going to talk about is that you should be greedy when others are fearful, and fearful when others are greedy. And the idea there is that, especially in terms of buying stock, buying securities, or making investments in general, is that in the time when everyone is buying, the prices are going up, the prices are high, people are getting greedy. At that time, that's the time that you need to be fearful as an investor. That's the time when you need to be cautious. When everyone is saying, and again, the idea of Mr. Market, and so he talks about that, and that idea of Mr. Market is talked about in Benjamin Graham's The Intelligent Investor. If you listen to that, you listen to the craziness, you listen to the madness, you listen to the frenzy, you're going to be buying at a time when prices are high, when things are expensive. Everyone wants to buy, and that's really what drives the price of stock up, is when everyone wants to buy, when the demand is higher. If that's the time when you buy, that's the time when you ought to be fearful, you ought to be cautious. And so be cautious when others are greedy, and then be greedy when others are cautious, or when others are fearful. And so the idea there is that at a time when the stock market is lower, at a time when people are fearful, at a time when most people, whether they're crazy or logical or not, when most people are saying, whoa, now is not a good time to buy, that's when you ought to have saved your cash, and that's when you ought to look at times to buy bargains. And another quote in Warren Buffett, or kind of a related quote to this, was that you should always look for good companies at that time, good companies at a fair price. And I think you'll find that, especially in looking at today's most common and profitable investors and prominent investors. Most of them, their philosophy is that they have a cash savings to be able to be put to use, and to spend that down at a time when the market might be down, when prices are lower, when things are on sale, when other people are being cautious. That's the time to be greedy. That's the time to buy. And so that quote came from one of the annual shareholder letters from Warren Buffett. So again, Warren Buffett, I'm going to talk a lot about him in future videos, and applications from his life, applications from quotations that he's made that can help you become a better investor, help us all become better investors, and I think better people as well, to do things with the wealth and philanthropic causes, and to be humble as well. So there's a number of lessons and a number of quotes I'm going to talk about, but the three that I talked about today, I think if you apply and you want to watch this video and think about that, or you want to dig into his book, and to Benjamin Graham's book, The Intelligent Investor, or to read the book, The Snowball, which is a long book, admittedly Valish shorter, the biography, I think you'll find applications from these quotes about being fearful when others are greedy, and being greedy when others are fearful. So at a time to make good investments, and there's a time when not to, when you might make bad investments. The other idea about debt and being over marginalized, that you'll know who's swimming naked, or you know who's skinny dipping when the tide is out. So that idea of not being over marginalized and not being in debt when you're investing. And then the other idea about buying companies. When you're buying stocks, you're buying companies. Buy something you understand, but that it's far better to buy a good company at a fair price than to buy just a fair or mediocre company at a good price. Until next time, be peaceful.